Let's bring in Peter Schiff, the guy we called Dr. Doom, president of Euro Pacific Capital. Good morning, Peter.
Good morning.
Peter, what is happening? What is your overall outlook on the consumer and on the economy in the coming quarters?
Well, as you know, I think our current prosperity, which, Bernanke promised to continue, I think is false. It's based on a premise that we as a society can continue consuming imported products and running up tremendous deficits in the process. I think what really needs to happen is we need to end this this consumption binge, and so I think we need to go through a very tough period of economic decline. We need to start saving again as a society. We need to start producing again, and that's going to mean a lot less consumption, a lot more savings in production, and a much, much weaker economy if you measure an economy by consumer spending.
All right, so let me interrupt you, Peter. If I get you correctly, you're not saying that we should be buying American products, which no longer exist, by the way, but that we need to buy fewer foreign products. Is that correct?
Well, sure. We need to make more products in the first place.
Well, I mean, how are we going to make more products when we're facing such a tremendous disadvantage in labor costs?
Well, we always had that. We used to pay the highest wages in the world. Back in the 1950s and the 1960s, our wages were the highest in the world. Japan has much higher wages than we do, yet they have record exports that they announced overnight. I mean, you don't need cheap labor to produce. What you need is limited government and high savings rates so you can have a lot of capital.
But access to capital, Peter, is not something I've been hearing is a problem for U.S. businesses.
Well, U.S. businesses aren't attracting capital to produce, though. The companies that need capital, productive, manufacturing, they're not getting capital. What's happening is we're borrowing money to remodel our houses, to consume, to take vacations, to buy imported products, television sets, consumer electronics. When Greenspan took office in 1987, the United States was still a creditor nation. Today, we're the world's largest debtor nation.
Yeah, and Peter, over that time period, we've had tremendous economic growth. Predicting doom based on the current account or the capital account deficit has been a really bad bet.
No, I think that growth has come at the expense of dramatically lower living standards for Americans in the years to come. We now have a situation where 55% of our national debt is held by foreigners, and as a net debtor, something unique has just finally happened in the United States, where the interest and dividends that we're going to have to pay to foreigners on the assets that they own here is now going to exceed, for the first time, the interest and dividends that Americans earn on their international investments. And as interest rates rise, and they're going to rise quite a bit higher than they are right now, that is going to be an increasingly intolerable burden for the American economy, as we are going to be struggling beneath crippling interest payments abroad. And when you add that to an escalating cost of living, for the first...
Peter, hang on one second. Kim Van Nebraska has a question.
First of all, I'm going to be on suicide watch in about 2 minutes, but what is the impact of foreign entities holding so much of our debt? Why do we care?
Well, we have to pay interest on that, and that's a net drain on the economy.
We'd have to pay interest if I held it, too.
Well, sure, but you'd be another American, so at least the money would stay in the United States, and it would, redistribute American purchasing power. But when Americans are saying that money to Japan or to China, it's a net drain on the national income.
It comes back in the form of loans.
Well, right now it is, but what if it doesn't? What if they stop?
What if the stock
Well, that's going to happen. You can look around right now, and you can see that most of the buying of U.S. dollar assets, contrary to the 1980s and most of the 1990s, it's not private investor demand that's funding our current account deficit. It's government demand. It's central banks.
Yeah, but that's trailed off, Peter. The private investors have stepped in. They're buying things like corporate bonds, and some of them are buying agency bonds.
A little bit. There is some...
Look, Peter, let me just ask you this. We've been sourcing a lot of our stuff overseas, $600, $700 billion on the trade deficit every year. The net result of those inputs is 3.5%, 4% growth.
Well, so I don't think we have growth.
If we can make caps and T-shirts for 80 cents in Thailand or wherever we make them, sell them for $8 here in the United States, what's the problem?
Because we have to be able to pay for them. We have to be able to export something in return for our imports. We can't just run $60 billion a month current account deficits forever and think that we're running a sound economy.
Yeah, but as the economy grows, that debt becomes less.
No, it's going to become far more burdensome now that interest rates are headed higher. As I started to state before, the inflation, and Alan Greenspan has been the most inflationary Fed chairman in our history. Money supply has basically tripled since he took office. But initially, the inflation was going...
That's 18 years. Well, you want the money supply to be held steady for 18 years?
Tripling in 18 years, that's unprecedented.
How much has the economy grown in 18 years?
That's not the point. Money supply isn't supposed to triple. But what happened is
if the
initially...
economy triples, the money's goes.
Let me finish this thought for a second. The money, initially the inflation went into assets like stocks, real estate, the bond market. What's happened in 2000 is that inflation has started to migrate first into commodities, then producer prices, now finished consumer prices, and we're going to start to see the inflation finally really manifesting itself in surging consumer prices,
okay, Peter,
and ultimately collapsing asset prices. We have
to leave it right there. I think we're going to come back to this issue again and again. Peter Schiff of Euro Pacific Capital, and Mark, it's just that doom and gloom again from the current account capital deficit that hasn't manifested itself, but it's out there and it's been out there.